So I think comparing and contrasting developed market investing and in general emerging market investing is that I think from a fundamental analysis of companies, you can approach a company in Poland, you can approach a company in Estonia, you can approach a company in the United States a similar way. But where we find the significant difference is in terms of kind of understanding the people behind the companies, understanding the macroeconomics, understanding the incentives system in which these companies operate. And that's where the decades of experience that we have in Eastern Europe and what sometimes is behind the numbers and what sometimes we feel is going to be driving these businesses over the next 10, 15, 20 years based on the incentives in the economy. I think that's a much more important piece in a developing economy than it is in a developed market where kind of rules of the game have been established and have been steady for a long time.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Steve Gorelik. In the spirit of keeping these intros short, find all about Steve in the notes. In 2 sentences, Steve was born in Belarus during the Cold War, moved to the United States, fell in love with investing, and has a lot to share both about the US market and the Eastern European markets. In my mind, both experiences build on top of each other and complete a much deeper, broader perspective that can be very helpful in long-term investing. If you want to hear more about how investing in 2 very different regions can make you a better investor, tune in and listen to our conversation. Hi, Steve. How are you? So nice to see you again.
Hi, Bogumil. Very nice to see you too.
Well, our paths crossed in Omaha. We didn't meet at the time, but we were both there at the same time. And then we had a chance to speak a few weeks ago and compare notes about our 2 decades investing in different places. And I was really looking forward to this conversation because, well, for so many reasons. And I think that will become more obvious to the audience in a minute. But I want to start from the very beginning, Steve, if you let me in. And you know that I like to ask my guests about the early days, childhood and upbringing. And I know you have a story. Do you want to share it with us?
Sure. I'm not sure if it's as interesting as some of your other guests, but I did grow up in the 6th biggest city in Belarus,
Uh-huh.
and which is not saying much, and moved to US at the age of 12. And I think from the point of view of where I came from, and that really shaped, even though I spent most of my life in the United States and in the West, and currently I'm in the UK, the fact that I did grow up in Eastern Europe and grew up under a communism regime really shaped me as an investor. And in terms of what and how I view the economy and how I view kind of productivity of the economy and decisions being made. So that was definitely a formation. It was, I think, somewhat unusually for people that would be coming from Eastern Europe. I wasn't necessarily interested in becoming a doctor, a lawyer, or a um, anything like or a software engineer, but I was always interested in how businesses work and how interested in economics, and that was kind of when I came to US. I was able to explore that a bit more, and have been doing this professionally for almost 20 years.
So you and I both share the upbringing in a certain economic environment. And, for many years, I think I was in a bit of a denial, kind of left that chapter behind. I moved on. I went to schools around Europe. I moved to New York. I became in New York. I became American. But then I realized I have certain reflexes that my colleagues that grew up in the suburbs of New York don't have, or certain sensibilities, or I ask the extra question, or I have a little bit of a doubt when I hear something. And I started to look for the answer. Where does it come from? And I think we all can trace back some of those habits, routines, beliefs from those early days. And instead of running away from them, maybe embrace them and see how they can empower us to do a better job no matter what we choose to do. And in the investment profession, I feel like a little bit of skepticism here and there, as much as optimism is important. I think a little bit of I'm not so sure this is true. Do you mind sharing that all over again with a bit more detail?
No, I think you're absolutely right, and I think I would take a slightly different angle to that because, and from what I understand, you grew up in Poland,
Yes.
and your environment was probably similar to me growing up in Belarus, where what we saw in our daily lives is the product of certain system of incentives
Yes.
that wasn't necessarily to maximize the well-being of the people. It was to maximize the well-being of the people in power through delivering on whatever incentives that were created for them.
Right.
And in a socialist environment, it's not so much. So if we're talking about incentives for an enterprise, it's not so to generate the most amount of profit, it's to generate the most amount of widgets. Whether
Mm-hmm.
anybody wants those widgets or not, that's a different story. And where the resources would come from, or whether you can afford to make the next batch of widgets because you sold these at the profits, that is completely secondary.
Mm-hmm.
And the result of that was that we did not have enough of the things that we wanted, could have potentially wanted to buy in the stores where we grew up.
Mm-hmm.
And when I moved to the West, then and saw a product of a completely different environment, and I hate to make it so consumer oriented, but
Mm-hmm.
when I saw the product of a different incentive environment and what you are able to get and how the business is operated, I developed a significant appreciation for the system of incentives
Mm-hmm.
and how they work. And I think that helps me as an investor too. And then I've been traveling to Eastern Europe quite a bit for work in the 20 years that I've been doing this. And you can see where some places kind of do this better and do this worse. And I
Mm-hmm.
had a really fascinating experience of going to Cuba about 4 or 5 years ago. I forget at this point. And I had a flashback to my childhood on the where you go into, there's a line of people in a store for whatever was being delivered that day,
Mm-hmm.
and you can't get it. You can't get that item. Where you have stores that are completely empty,
Mm-hmm.
and that was an important reminder of where I came from and where things stand.
I think it gave you and it gave me a big appreciation for the free market economy, for the incentives that follow, for the importance of profit, that it actually makes sense to do something, deliver something, that somebody wants it, somebody will pay for it. And that secret price discovery system that exists in a free market economy that guides all of us, all the way from a baker that wakes up at 4 a.m. to make the bread for you, all the way to, I don't know, a software engineer that decides to work the extra hour because they get paid more and they can go on the vacation that the wife has been looking forward to. Like, you have a system that just flows, and you think that you can take all of that away, and somehow a bureaucrat somewhere in a gray building in Warsaw or Minsk or Moscow can decide what Steve needs today and where Steve's wife wants to go on vacation or not, instead of leaving it to the individual. And the other thing for me that's important is ownership. You get to own things. You get to own your ideas. You get to own your business. You get to own your destiny. The ownership, there's a huge freedom behind it and choice that's very elusive. And when you talk to somebody that has not experienced lack of it, it's almost like you're explaining water to the fish. What do you mean?
That's a good way of putting it.
I manage money for wealthy individuals and families, and I've been doing it for 20 years, and I absolutely love it. But I get to hear fascinating stories of families in the U.S. that have had some mineral rights for 4 or 5 generations and passed on and passed on, and they might be still paying something. That's something unimaginable in my part of the world where I grew up, because there were wars and conflicts and devastation, confiscation, and everything else you can imagine. If you held on to something, it was only the shirt on your back.
But to give credit to the region where we both came from, is that I have seen the transformation over the last.
Yes.
So it has been, at this point, we're talking about 35 years since the region has stopped being communism and the ideas of capitalism started to permeate through the society. And I've been investing in Eastern Europe since 2005. The firm that I work for has been doing it since 1994. And the difference in the mentality of the people that we talk to in 2005 and 2015 and 2024 is amazing from the point of view of understanding what it means to look for return on capital.
Mm-hmm.
And when we think about it, like, because when in 2005, there was about 15 years of experience of capitalism. And at this point, we can double that.
Yes.
And meanwhile, the situations that you're talking about, when you have 5th generation families, they kind of, the incremental amount of knowledge that they had relative to what they already had is not that large. Maybe we're talking 3%, 4%, etc. But from a point of view of the businesses that we're dealing with in Eastern Europe, we're talking about doubling the amount of time in which they had a chance to make mistakes and learn what works and what doesn't work. And what we have seen, and this is one of the things that is, I feel, completely underappreciated, for all of the risks that investing in a region like Eastern Europe, which is unique from a emerging market perspective, because it really didn't China may be similar, where you had a period of communism being replaced by somewhat of quasi-capitalism. But in Eastern Europe, you had that complete replacement. And the learning that is occurring in the businesses and the quality of the businesses you're getting as a result of that, I think, is being completely underappreciated.
I agree. I would add to it. So I was born in 1980, and 1989, 1990, when the transformation happened, there were already people that knew how to do business. They were, so there was a gray economy happening in the background. People would sell things, and so there was. All I want to say is that it's almost like a human experience and human instinct to trade with each other. I have something that you want, and communism in just broad strokes just took that away from you. You were not allowed. It was illegal to do that. So as humans, I collect coconuts, you collect bananas. I want your bananas, you want my coconuts. That's how the economy flows, all the way to very complex systems that we have in place. But it's human. So if you tell people you have to deposit the coconuts in a warehouse that belongs to the government, where the bureaucrat will decide if Steve will get a coconut or not, you disrupt something that just naturally exists. And I think that's what escapes a lot of academics and people that philosophize about the economy. No, it's a human condition. It's a human thing. We just want to trade. We want to exchange. We want to provide value. We want to find a way to provide value. If you just let people be, I'll grow coconuts, you grow bananas, we're both happy. And everybody in between that wants something else or does something else will be happy too. It's a very basic idea, but then you put all the interpretation and theories and monetary concepts and on top of it, and you kind of say, let us decide for you. And I think that's where the conversation gets lost.
Yeah,
I want to
and
take.
I'll just to follow up
Yeah.
on that, because I'm sure every family has a story of they went through the late 80s, early 90s, and figuring out how to make money. In my
Yes.
family, I have an older brother who was going to university in Moscow. As I mentioned earlier, I'm from a small city in Belarus, but my father knew which books were in demand
Uh
that
huh.
were not in our city. So my brother, every time that he would come back from college, he would have this huge kind of hiking backpack full of books that we knew that we could resell for a lot higher value that were available in Moscow and weren't available in our city. And that's
Uh
how
huh.
we were making that money. And I think everybody had some way of doing this.
Hmm.
And
Humans have a way of appreciating opportunities, and
yep.
we just find them if we are a little bit aware and if you were curious to find them. And that brings me to the bigger topic that we want to talk about today, which is investing. And I'm very, very curious. How did you discover investing? How did it happen to you? Was there a moment, a book, a person, a conversation that opened your eyes and you realized this is what I have to do with the rest of my life?
I can't pinpoint it to one particular event. I think was a little bit of a process of elimination and discovery.
Mm-hmm.
My first couple of jobs, my internships while I was still in college, was had to do with. So my first one was on working for this company called IBIS, Institutional Brokerage Estimate System. Some people may
Mm-hmm.
it's owned by Fact now, so probably a lot of
Mm-hmm.
your listeners will know about it. But my
I know it.
yeah, but my first job was to be putting together this average earnings per share estimate. And back in those days, it was coming from uh, literally pieces of paper that was sent in by the sell side shops that was sent to IBIS. And you
Uh-huh.
had to compare it to what you had in the system. And if number changed that you put it in.
Mm-hmm.
The curious part of the job was that if there was a number that was stale, so if it was like 3 or 4 months old, then I had to call that particular analyst, a highly paid analyst, and ask him, has your opinion on the company changed by chance? And more often than not, the question that would come after that, well, what is the current average estimate?
Uh-huh.
I would tell him that. And then he would give me a number that would be within,
Close
either
enough.
right close enough, either right on it or a little bit above, a little bit below, and then a couple of days later, you would see a research note come out backing up that number.
Mm-hmm.
Based on that experience, I kind of for all the knowledge and the experience and the fantastic people on the sell side,
Mm-hmm.
I was a little bit discouraged by that by that profession, even
Mm-hmm.
though I thought that the intellectual experience of learning about the businesses and following them is fascinating. But I didn't feel like I wanted to be in sell side and participating in that. And then next job after that was I was working as a quantitative analyst
Mm-hmm.
because of kind of my background and where I was coming from, which the university I was going to. And I also it was once again a job where it was somewhat separated from the fundamentals of the businesses. And I kept finding myself being more and more interested in what the companies do.
Mm-hmm.
And then my first real job after college was being an operational strategy consultant, where I truly got to experience and learn from the companies in different industries and started establishing kind of mental models in terms of what I think how the companies work, how the companies make decisions. And from that, the best way that I thought that I could utilize that knowledge going forward is an investment management profession. And then from there, it was kind of a combination of a little bit of skill and a little bit of luck. But while I was in business school, I was lucky enough to be participating in applied value investing program at Columbia, and so I got completely indoctrinated with the value investing ethos and I learned just completely randomly by reading the Wall Street Journal about a company called Firebird Management that is investing in Eastern Europe from a fundamental investment perspective. And I realized that this is where I need to work. And I kept calling them until they picked up the phone.
Uh-huh.
And I was able to convince them to kind of give me an internship on, because I had an angle of where how my operational strategy consulting experience would help. And kind of I've been doing that for the next 20 years. So it's kind of that's where it came from. So I can't pinpoint to one particular event or one particular book, but it was a kind of combination of factors that got me to where I am today.
But on that journey, you discovered a couple of things about how the business of investing broadly defined works, including the sell side and buy side. And for the benefit of the audience, the sell side is basically operating in a very different world than the buy side. The buy side wants to buy, hold, and own and benefit from the long-term upside in the business. The sell side lives off of commissions. The industry has changed a lot and the commissions are not what they used to be, but back in the day, the commissions were pretty high and there was a lot of business, and sell-side analysts and sell-side would attract a lot of very gifted people that I got to meet, and they knew the businesses very well, and they knew the managements, they knew the story, and you could get up to speed very quickly with them. And a lot of them moved to independent research shops these days or started their own Substacks and so on. And it's fascinating to see how their work evolves. But the system that you mentioned, I think it's worth pointing out, is the world evolves around the quarterly earnings. And there's still a lot of excitement around the beat or a miss. And the stock prices respond to it. And they respond to the guidance, and they respond to a couple of data points in very dramatic ways sometimes. Even in the last few weeks, we saw some gap downs of 20-25% in very established companies. But then you look closer about how the incentives work, and the sell side is not really here to tell us what to buy and what to hold for 3-5 years, what you and I are trying to do, or longer, hopefully. But they're in the business of looking right, and right meaning are the earnings where I told you they're going to be, $3.50 or not. And when you really look closer and think about it, and I think you, for your process, had a chance to really think about it, you realize maybe it's not a game worth playing, not for me, if you want to be an investor. But I think a lot of attention, a lot of noise, a lot of conversation is still around quarterly earnings. I love reading, by the way, quarterly transcripts, and I actually take the time, and I had a couple of conversations on this podcast, that I want to hear the voice of the management when they tell me the story. And I just want to see how it's delivered, because when you read a transcript, it's kind of a single dimension experience. You have the words, but you can say to somebody thank you in 10 different ways, as in, I'm really grateful, or you can say thank you, the tip is too high. You can say it in a million ways. So I love to hear the voice of how people talk, but that's way beyond the actual earnings per share. I want to talk about the dual experience you've had. So the US market and Eastern Europe, and let's start with Eastern Europe, but if you can compare, contrast the two to begin with, I'd be very curious. And you kind of hinted on the difference between the two worlds, and you use a similar approach, but not the same approach. Can you talk about how the markets are different? And the Eastern European markets have changed a lot quite in the last, 2-3 decades, of course. But what are you seeing in terms of, for somebody that has no experience ever investing in Eastern Europe?
So I think comparing and contrasting developed market investing and in general emerging market investing is that I think from a fundamental analysis of companies, you can approach a company in Poland, you can approach a company in Estonia, you can approach a company in the United States a similar way. But where we find the significant difference is in terms of kind of understanding the people behind the companies, understanding the macroeconomics, understanding the incentives system in which these companies operate. And that's where the decades of experience that we have in Eastern Europe and what sometimes is behind the numbers and what sometimes we feel is going to be driving these businesses over the next 10, 15, 20 years based on the incentives in the economy. I think that's a much more important piece in a developing economy than it is in a developed market where kind of rules of the game have been established and have been steady for a long time. And that is part of the reason why we feel fairly comfortable investing in Eastern Europe because we've been doing it for 30 years. But we didn't feel comfortable taking our investment approach and trying it in another emerging market. Rightly or wrongly, we feel that we're very comfortable knowing the players, knowing the people, knowing the companies, knowing the incentives in Eastern Europe. And we had to start over in a place like Southeast Asia or Latin America, then we would have to make the same mistakes over and over again before we get that knowledge, institutional knowledge within our firm. And that we just didn't think that that was very fair to our investors as well to even offer them that type of a product. And we didn't feel comfortable doing that. But we did feel comfortable taking our fundamental investing approach, which is in the simplest form, trying to understand how companies make money and how companies spend money. And whether how companies make money, which is the competitive advantage, and how companies spend money, which is capital allocation, whether we can agree with both sides of that equation. And that we felt was completely translatable. And we decided to apply that about 10 years ago, slightly more than that, to our investing in US. And initially it was really more of a PA, personal account type of investing, but we talked to enough of our existing investors about this, that all of whom have been doing investing in US on their own. Mm-hmm. And they felt comfortable enough with our investment approach to let us try to do for some of them and to launch a fund on that basis. But as far as the kind of going back to your question of what is the difference between how markets operate, is that I think one of the major differences to understand is where the marginal buyer is coming from, or any particular security, any marginal buyer or marginal seller, and what is their cost of capital. Because you can have a market like Romania or Kazakhstan, Georgia, and you will look at a company that is trading at a very low PE relative to what the same type of company would trade in US. Mm-hmm. And you would wonder why that is. But in a market that does not have a lot of foreign investor participation, the person who's making that marginal buy decision is probably a local person. In a place like Kazakhstan, if we go with that, for example, there where the interest rates are very high, you can get, if you are investing in domestic currency, I think you can get a double-digit rate on your deposits in just bank deposit. So obviously, for that person to take a certain risk within a public equity, given where you are in the capital structure, well, you will want return of 20% plus. And right. That means that the multiple that they're willing to pay for that earnings is going to be single digit. And that is the explanation for why these companies, high quality companies, are trading at a low multiple. But that also, once we find the right type of company, and we know that we can get in and get a high quality business that's growing at a fairly healthy rate, at a very attractive rate of return. Because to us, that 20% per year, especially when we're coming from US, even if it's a local currency and you take into account the devaluation that could come, well, it's still pretty attractive. Mm-hmm. And so we can make a reasonable return on that investment without any new person showing up. But at some point, the market could get excited and new people will come in and will look at this and make the same calculation that we're doing. And that's when we see multiples going up, because the multiples are going up because other investors from places with lower cost of capital are stepping in and saying this is interesting. So that's great. And you don't really have that happening that often in development.
You're touching on so many fascinating ideas. So let me bring up one or two things that I can relate to and bring back some memories. I took a course in developing markets, developing economies when I was in Brussels, and I was an exchange student in Brussels for a year. And I pulled my professor aside and I asked him a question that really dawned on me as I was listening to him 20 some years ago. Argentina was going through its default and crisis, and I think that was the moment when people's savings were decimated because they thought they have them in dollars, but they were converted into a local currency. But I asked him, were these developing markets when you were my age? And he was 60, I was 20. And he says, yes. And I asked him, when I'm going to be your age, are they going to be also developing markets? He says, I don't know, but possibly. And And it dawned on me because we have those concepts of developed and developing, and just using the different tenses and the conjugation of the verb. But one says you got there, and the other means you're going to get there, hopefully one day. I think Eastern Europe is different on that front because those countries played a huge catch-up from a frozen state to a free market setup with a huge potential, with educated people, with, I think, a very entrepreneurial mindset. I met a lot of people that are much more entrepreneurial than many people I met in Paris or Brussels. In the US, I meet very entrepreneurial people, but Poland was, in the whole region, I met people from all over, including Belarus. I thought that people just want to take risks and accept risks and are more comfortable with risks than a lot of people in the rest of the Western Europe. So those countries, including Poland, were playing a catch-up. Like, how do we set up structures? How do we set up things? Simple example, land ownership, property rights. It was all mixed up, messed up. But you knew that if you waited another 10 years, they'll sort it out, they'll clear it up. You will have a legit record of ownership and so on. And there are parts of the world, and I'm thinking, South America, not picking on anybody, but it feels like they're still developing and they're going through massive ups and downs, but there's a feeling that we might never get there. I visited Brazil and I met people that have businesses that are very entrepreneurial, very successful, but they're up against a system that's going through big ups and downs. And I feel like Eastern Europe has been mostly on this upward trajectory. We've had a lot of different stories by country. I think it's very hard to generalize, but it's kind of, we're trying to catch up. And when you walk around Warsaw these days, I mean, this looks like Amsterdam. There's this it feels like Amsterdam or any other city. That wasn't the case when I was 8 years old. It was a different place. It was like living on Mars. I didn't know that at the time. Do you have a thought about it? I feel like we all throw it into an index and say, I own developing countries or I own emerging markets through an index. But if you look into it, you have different continents, different cultures, and a completely different even trajectory. Yep. Do you have some thoughts about it?
I think a couple on that subject, because one of the things that we try to understand is how the businesses are making decisions. And right. Then whether whoever is in power, because one of the things that you're touching on is to what extent is the person in power or the party in power during that day, during that time, is influencing long-term investment decisions.
Right.
And you can have a situation in which a decision has a 10-year payback, but the people in power will only be there for 5 years, and you don't know what the next people are going to do. And that is a difficult way to make decisions. Mm-hmm. Or you can have a situation in which it really doesn't matter. And so we refer to those kind of more post-political countries where you can have elections, you can have noise around elections. And I think maybe Poland is a good example of that, where you had a significant change in power first to people who were now you have pro-EU people. Now, before that, you had people that were kind of more kind of
skeptics.
Yeah, that's a good way of putting it. EU skeptic, populist. But I don't think the way that businesses that made decisions on the ground have changed dramatically. Maybe somewhat on the margin, but haven't really changed dramatically on the ground. And there are plenty of other countries within Eastern Europe where that is the case. There are other countries where that could be more authoritative, where people are making decisions more from a point of view, well, this person is in power. We can count on one way of doing things, but when somebody else is going to be in power, it could be completely different. And the way that we define it within kind of our scope is that you can so if you put like a 2x2 matrix where you have corrupt versus non-corrupt and democracy and democracy. So you can make money in a non-corrupt democracy, that is, a place where normal decision making is made. You can even make money in the corrupt autocracy.
Right.
Because the system is there, that's in place, and it's probably going to be in place for quite a while. And the people in charge are kind of incentivized to grow the size of the pie so they can cut it, but there's going to be things left over. But it's very, very difficult to make money in a corrupt democracy. Because what happens is that whatever the election cycle, 4, 5, 6 years, every time there's a risk that the people in power get replaced. And when they get replaced, then the new people in power will think that, well, I only have 6 years, so I got to get what's mine, instead of thinking of what's right for the people and what's right for the businesses. And it's very difficult to make decisions within that. And you can look at things like the uh, bank loan books, whether they're mostly investment loans or working capital loans, and they depend on what kind of a environment people are in, because a
Mm-hmm.
working capital loan has a very different payback than an investment loan. And then, so that's one of the things that we have looked at, and we have looked at seriously. And there's countries within our region that unfortunately we don't feel comfortable investing in, because we consider them to be corrupt democracies. Until they change, until they evolve into something that we would consider to be post-political. And that
Mm-hmm.
process of evolution is extremely profitable, because you have if you can capture it in the right time, then you can get a country that is going from a corrupt to a non-corrupt environment. The
Mm-hmm.
decision gets better, and you get just wonderful businesses at very fair prices that have a significant runway for growth. And we hold, in Eastern Europe, we hold companies on average for 10 years or more. And it's because we're able to get companies at the right price, and they're able to compound for a really long time.
It's fascinating to add that additional dimension, because from outside it looks like that's a democracy, but they might be very different democracies. And I think also it gives you appreciation. So you're based in the UK now, but you lived both in Eastern Europe and for decades in the US. And I think it gives you, both of us, I think, a different look at the US politics, or in general, even European politics. I lived in Paris, and I watch what's happening. I'm curious. But I think the range of outcomes, as dramatic as it sounds on TV, it's much more narrow compared to what you and I might have seen. And I think
Yeah,
our
and
colleagues from South America might have seen in their lifetime.
exactly. And I don't think it significantly, I mean, I could be wrong about this, but I don't hear many businesses delaying investment decisions based waiting for the outcome of the elections, which is what you want.
I definitely know, families in different countries where they basically pause their investment
Mm.
plans, capital expenditure plans, depending on what the election outcome will be. Not in the U.S., in other parts of the world. So it's very sensitive, and you're pointing out something really fascinating. You just don't know what the rules will be after the elections. That's thankfully not the case in the U.S. Still, maybe in some industries there might be some shifts
Sure.
when the parties change, but in general, you could say that you are still allowed to go and shop wherever you shopped with the same money you used before, and on and on and on. So there's a range to it. I want to bring up something. We were talking about the macro, but a little bit of a micro perspective. You mentioned in your writing how in many cases a lot of those businesses remain family owned in the region. And I found it very intriguing, because I work with families that have had a business and sold it and turned it into a portfolio of stocks, of holdings, investments, and so on. But the fact that there's a family present in a business, I do know, and I appreciate the benefits of it. The family has a long-term view. The family is not as sensitive to earnings per share and what the analyst says. The family has a plan, and the family usually has a long-term vision. Can you talk about that presence of family ownership in the region?
Yeah. So most of the companies that would be listed in Eastern Europe will either be state-owned or will be majority owned by either a group of individuals or a particular family. And it's exactly what so state ownership is a completely separate discussion.
Right.
But as far as companies that are majority owned or have a significant shareholder, what we find is exactly what you're describing. It's a situation in which we see the businesses making long-term decisions
Mm-hmm.
for from the point of view of what's good for the company in the next 5 or 10 years, as opposed to the next quarter. And because our investment horizon is similar to theirs, we feel very aligned, and we feel very comfortable talking to these companies. And they like talking to us too, because we are asking them questions about the next 5 and 10 years, and how these investment decisions are influencing what the company will look like 5 years down the road, and not asking them what the next quarter is going to look like or how is the business this month. And they appreciate that.
I'm thinking of Tony Deaton. I don't know if you're familiar with him, his work, but he likes to own family owned, operated businesses around Europe. And he grew to appreciate that you need the family at the helm to have that kind of stability. I remember going to a particular conference every few years, and right before COVID, I showed up again. And I was surprised, or not so surprised, how many of the CEOs that I used to know are no longer there. Their tenure is a year or two. It's scary how much of a turnover we're seeing among the leadership of so many incredible good quality businesses. But still, so if you mentioned politicians that have a short-term time horizon, they won't be around to see the results. But imagine a CEO and a whole crew that manages a business that has really 2 years to show the results and 2 years to have their compensation, everything vest and so on, and so they can walk away. How can they possibly be thinking in terms of 10 years or 5 years or a long-term plan or developing a new product line or entering a market that will not see profit for 5 years because it's a new market with no presence and no brand recognition, on and on and on, right? I think there's this conflict of interest that's appearing, and I'm curious where it's going to go. I'm hoping we're going to go back into long-term thinking. Maybe I'm too optimistic, but I feel like what shareholders want eventually will gravitate towards the long term. I hope, fingers crossed, that's my thinking. And those kinds of managements, I think, are worth a lot if you can find people that are here to stay and stick around for longer. Best case, if you have a family or, as you said, a majority shareholder that's there, that's still pointing the ship in the right direction. But I think there's a conflict when you have a 1-2 year, 10 year of the management and expectations that they'll run the business for 5 to 10 years. I'm curious from your experience in the region, and maybe a different experience that you've seen in the US, and we'll come back to it, but without naming any companies, but just themes, what are the biggest winners that you've seen, and which companies caused the most trouble from your experience in the region investing?
The biggest winners, it's relatively easy, is that we have done really well over the years by buying the best financial institution in a really good economy.
Mm-hmm.
So if we find a country that has the right setup from the point of view of the economic growth, and if you're buying a best bank in that country. So what you're able to do is you're able to get kind of a levered look at the whole economy, because the whole economy will be flowing through this bank because of the loans that they're making and the deposits that they're getting from the population. So all of the economy is flowing through the bank. It's levered because of the business model. And you have locally owned financial institutions that have a significant competitive advantage compared to the financial institutions that they're other financial institutions in the market that are quite often foreign owned. So when we're looking at countries like the Baltic countries or in Poland or in Romania, you would have a significant chunk of the market that is owned by large foreign banks. And in order for those companies, which are very good companies, but in order for them to make a decision on the loan, they quite often have to go and look at the kind of either go ask for specific permissions from a head office or look at the very strict framework that were given by the head office that this particular station may not fit into. So that's where the local institutions that can make decisions fast, and they can make a decision taking into account sometimes the local flavor of something that's happening, they can win time and time again and grow their market share. So what we're able to get, and then we have businesses that have delivered 40, 50 time returns for us over the years that have been able to gain share in a growing economy and do so very profitably, both for them, for their customers, and for us as shareholders. So that's been a favorite theme of ours. As far as the things that didn't necessarily work out, going back to what I was talking about earlier, is that the idea of that it's very difficult to make money in a corrupt democracy. Well, we learned that the hard way, because there's certain countries in our regions that are corrupt democracies, and where you can have a really attractive looking business and a really attractive looking situation, but if you go through a period with the political upheaval or economic upheaval, that quite often those fundamentals completely go out of the window, and the business owners are really looking out more for themselves. And you, as a kind of owner of the kind of the marginal, as a equity holder, because of where you are in capital structure, you don't really have that. You're getting the marginal profits that are
Mhm.
being generated. And as a result, quite often that led to very poor investment returns that we learned the hard way that, you know what, we're not going to be the first people in a country that seems to be transforming itself, and we can wait.
You touched on a couple of interesting things. So let's start with banks. Just as a reminder, Buffett invested in banks and continues to do so. I had John Maxfield on the show, whose family has been in banking for multiple generations, actually owning banks, and we had a fascinating conversations. Banks are a peculiar business because there's no shortage of demand for the product that they offer, which is the loan. Right?
Yep.
They could write an unlimited number of loans almost, but they have to actually have some discipline, and they have to choose and pick who deserves a loan. And in good times, it doesn't matter. In bad times, it becomes an issue. But with banks, you could tap into a long-term growth trend that you talk about. And if they're positioned very well and managed well and disciplined, because it takes a lot of discipline to run a bank, they could benefit from what the economy is experiencing, which is expansion and growth and success of both the consumer and the businesses. So it's a fascinating idea. I want to briefly bring up the idea of being a minority shareholder, which is something it's on my mind because, when I discovered investing, I picked up a book by Peter Lynch, One Up on Wall Street, and I thought, this guy is basically telling me I can become a business partner, an owner of businesses out there, small and big, right? I don't have to be somebody's nephew. I don't have to know somebody. I don't have to be from the right school or of the right age or whatever. I can just buy the shares. They're out there in the public market. Now, there's a catch because I want to be treated fairly, and I want to be treated as a small, sometimes very small shareholder, at least at the beginning, with the same care and respect as a majority shareholder, which is not a given, even in the US. But globally looking, I've seen things, and I'm sure you've seen things where, as a minority shareholder, you're not treated as well as somebody that actually owns half of the business and so on. Do you have some thoughts about it as you expanded your investment horizon outside of the US and you realized I have to ask a few more questions around this?
Sure. So I think fundamentally what you're talking about, and we have a business partner that kind of defines it very, very nicely, where he said that one of the questions that I want to ask the management, you don't ask it directly, but you try to understand that if I
Yeah.
own 1% of the business, do they feel that I get to own 1% of the profits? Do I have 1% of the interest in everything that they do? And you
Right.
can get to that really from a point of view of talking about, I keep going back to the idea of how companies invest, because you try to understand their investment decision and what they're doing with that money, and whether your decisions would be similar to what they're doing, and whether you can get comfortable signing up to them.
Mm-hmm.
We have been introduced, on the flip side, we have been introduced by at least one of the companies that we were talking to a concept of a non-working shareholder. And when we
Okay.
asked them, what is a non-working shareholder? They're like, well, it's a shareholder that doesn't work for the company.
Uh-huh.
And we're like, what does that mean? And they say, well, you guys don't really deserve the same thing that we do because we work for the company. I mean,
Interesting.
that's where the interest in the company, our interest in the company stopped. But I think they defined it very well in terms of
Uh-huh.
how they think,
Uh-huh.
in terms of what happens with the money that this business generates. And that's going back to the discussion that we had about state-owned enterprises, that quite
Mm-hmm.
often, especially in emerging markets, you can find a company that's trading at a ridiculously low multiple, but the reason for
Right.
which reason why it's trading at a low multiple is because the profits that it generates do not belong to you. They
No.
belong to what will be done with them is what state and whoever
Uh-huh.
is the functionary there at the time will feel is the right thing to do with that money. And it could be it does not have it will be completely different from how you will decide. But
Mm-hmm.
if it supports state policy in a certain way, and they may invest in a business that has nothing to do with their core business, or they may develop a project that has completely negative rates of return, but they will do it because that's what the state wants them to do. So we try to avoid those situations too. But that it all comes down to incentives and figuring out what happens with the money that the businesses generate.
I think it's a brilliant remark, and I think it's great. It's a great reminder for anybody that's looking outside of their domestic market to understand the circumstances of your investments outside in a territory you might not be familiar with, right? Just because you bought something, the same way I buy Coca-Cola shares, you could have bought shares in some new country you've never invested in. What do you actually own? And you highlight the second part to that. Do you have the real right to the profits? And do they acknowledge the fact that you are a true, full shareholder and you have the right to the profits the same way the folks that are involved in the business or the state officials or the state appointed officials have? If the answer is I'm not so sure, it's probably a no-go. And I think it's worth considering that when you think that you own something and you have the same right to receive profits or to collect profits in whatever shape or form. I think that's worth remembering. And it's something that I think escapes a lot of people that assume, well, it's just like buying shares of Coca-Cola. No, there's a lot more to it. And I think it's worth asking.
Right.
And some of us intuitively know that there are a few extra questions worth asking before the conversation ends. I know you've done some soul searching lately over thinking about the last 10 years of investing in U.S. equities.
Yep.
Can you share what you've learned? I really like that piece, and it got me thinking, looking back, it's always beneficial to see what I thought, what I changed my mind about, what I learned from it, how am I going to use it in the future? Can you talk about that soul searching journey you've done in the piece that you shared?
Sure. So for background, as I was talking about earlier, we launched a US strategy about 11 years ago. And it turned into a fund 10 years ago. And that was a reason for me to look at it and say, well, what did we do right and what did we do wrong over the first 10 years? And really from a point of view of figuring out how we can be better over the next 10 years. And that was really the main purpose of writing that article that I would be happy to share with anyone who is interested. But it also kind of to learn in public and to put it down on paper to kind of get away from the situation. Well, we thought this, but it's that. And then kind of it's very easy for us to justify different decision making. So I wanted to put it down. And our investment process involves quite a bit of putting down thoughts on paper, making sure that to get away from things like thesis creep, for example.
Right.
And the few things that came out of that piece and looking at over the 30 years, over the 10 years, we made about 120 investment decisions. So to buy and sell companies. So looking at what was the result of different decisions, classifying them by different type of companies, looking at different factors of what those companies had, what they didn't have, what worked and didn't work. And a couple of main pieces, kind of takeaways from that was what kind of companies we are good at investing in and which kind of companies we're not so good at investing in. It doesn't mean that those companies are investable or uninvestable. It's more about, I think with every investor, you have to find what you're comfortable with because this will give you the conviction to stay through with the investment if it goes against you. Because you and I can argue whether we should own NVIDIA or not, but if I don't have a fundamental belief that it's worth this and it's going to go up X and for these reasons, if it goes down 10%, it's very difficult for me to hold it. Mm-hmm. But the positions that I usually have based on looking at the fundamentals of the company and based on the thesis of how things will develop. And then you can look at the thesis whether it's developing a certain way or not. And looking at the investment decisions that we made in the past, I realized that there are certain categories of investments, which in my case, companies that have shrinking addressable market. Even if when they're buying them at really attractive multiples, and it looks like it's very good moment to buy them, quite often we did not make money investing in those type of companies. On average, we didn't. There was some successes, there was a lot of negatives, but my investors would have been much better off if I would never touch those companies at all. Mm-hmm. So that was an important takeaway in terms of when I'm looking. One of the things that I'm looking at when I'm looking at a new company, one of the first questions that I'm asking today, well, is the addressable market growing?
Right.
And if it's not, I'm probably going to avoid it no matter how interesting the company looks. And I could be wrong about this, but this is, in that fund, we only own 30 companies, which means by definition that we don't own 3,000 companies or more.
Right.
And that is just another company that I need to own, and I will own a certain type of company. The other takeaway that has been is that in terms of when to sell the companies where your thesis is working out. And what I've learned is that quite often the companies that I sold that have been doing quite well, and the thesis is working, and it feels like, well, at this point it reached its fair value, and I can move it to, I can reinvest into something that I think is much further from fair value. Well, the best thing to do would have been just to stay with that investment.
Mm-hmm.
And I think there's a couple of reasons for that. The reasons for that is that when you have figured out something and eventually the market is catching up with you, then the momentum is on your side. And moreover, the company is doing the right thing. And now the market agrees with you. So when those two things come together, this company could do much better than you ever thought. And just There's no reason for you to get in the way of that. So I have companies that I have invested in and I've sold because I thought that they were fairly priced that continue to compound at 20% per year or more for the next 5 or 6 years.
Right.
And so whenever we sell, I classify things as either sold because it's too expensive or because of change of thesis. And when I sold things because of change of thesis, more often than not, those were the right decisions. Mm-hmm. But when I sold things because they were too expensive, more often than not, that was not the right decision. And there is a certain point where like it does feel, and now I kind of, as a result of that reflection, I am letting the company stay in the portfolio a lot longer than I would have otherwise. Mm-hmm. And so far that's working for the benefit of the investors. So I think those are kind of the two main takeaways personally, but I think I would go back and say that for anyone who's doing this, it's very important to have the investment journal. Take a look at what you're buying, take a look at what you're selling, mm-hmm. and be honest with yourself when you look at those decisions once you accumulate enough data points.
I think it's brilliant. I'm personally very meticulous about keeping notes, and there's a certain human experience that when you go back, you think you knew that at the time. And just being honest with yourself that, no, we didn't know that. I didn't know that at the time. This is all I knew. And based on that information, I made the decision. There are two things that you brought up that I really like. So I call myself a value buyer, but a growth holder. Like if you really have to put me in a box, because I like to get a good deal. I want to buy a quality business and all the things that you can think of, but I want to get a deal. And I get a deal when there usually is some emotion-driven panic around an industry or a stock. I mean, ideally the whole market, but hopefully it doesn't happen too often because it's very disturbing and distracting for people. But one stock at a time, you can find things that are off by 30-40% because of a couple of earnings misses, because of a delayed product launch, because of things that are fixable while the brand and everything else is still intact. The market reacts, and that's the benefit of the public market. Daily quote, people panic together. You can go in and buy something 30-40% off, which, by the way, would be almost impossible in the private market. If you have a family-owned business that had a few weaker quarters, the family is not running around trying to sell the business. In the public market, it looks like this imaginary panic Mr. Market is running around and trying to sell your shares.
That's a great point.
And it's a huge advantage. If you can keep your emotions in check, if you can be pretty, logical and rational about it, you can buy amazing businesses. And even as we speak today, I can make a short list. I wish it was longer, of companies that are, at 5-10-year low that are worth a look. I don't know if they're all buys, but they're worth a look. So there are things always worth considering. The other thing that you pointed out, you called it shrinking addressable market. I call it secular decline, which rhymes with what you're trying to pinpoint. I look back at the ideas that cause trouble, and I find companies with questionable managements, too much debt, and secular decline. And sometimes all three happen together. I think once a business faces a secular decline and you have management that tries to, I'm not saying that they're fraudsters, but they could be over-promising, under-delivering consistently. That's already a problem. And they're trying to use debt to cover it up through some quick acquisitions, aggressive acquisitions of weaker quality businesses just to show some growth. you can get yourself in trouble. And I think we can get ourselves in trouble, those of us that have some sort of a value bias or a value-oriented way of investing, because we see something that got cheaper and cheaper and cheaper and cheaper, and we could underestimate the fact that it's getting cheaper for a reason. And one last point I want to make, when you talked about those companies that continue to compound, the one thing that I removed from my vocabulary is price target. In the early years of my career, everybody loved the price target. And I think sell side just loves price targets. And then a lot of buy side people start to speak the same language. So as a junior analyst, almost a quarter of a century ago, people would say, what's your price target? I know you like it, but what's your price target? So you would say, 50. And you have a huge dilemma once you get to 50. Let's say you bought it at 25, it gets to 50, you're a hero. And there are many others that you're not a hero about. So that's it balances itself. But you get to the 50. What do you do? Right? Because you feel on one hand, look, Steve, I was right. It's at 50. And it's a huge boost to your ego and satisfaction. And everybody says...
You want to close the trade so you stay right.
Right? Exactly. But then you realize, I put in so much work to get to know the business. I bought it at the right time. And I think the point you were making is, listen, this could be a $200 stock. Or taking Chris Mayer's and Phelps's idea of 100x stocks. This could be a much bigger business, right? I could make 100, it's an aspiration, but let's say 50 times your money or 20 times your money. I've seen that happen. The price target will not capture it, and you will not keep up raising the price target fast enough to convince yourself to sell. And I want to go back briefly to what you said about conviction. NVIDIA, we can pick any stock out there. Buying a stock and holding a stock are two different things, right? Everybody can buy a stock, but only very few of us can hold the stock, right? And I think, and I know that you can't outsource conviction. Conviction has to come from within. And I don't know if it's the pages you're going to read or the management meetings you're going to take or the earnings calls you're going to listen to, but you have to earn that conviction. And that conviction will allow you not to sell it at those times that will happen for sure when everybody else is selling.
Sure, but there's more to it. It's not just the conviction to hold, but also the conviction to admit that you're wrong.
Yes.
And move on. Because there's a lot, unfortunately, people pay us money to make difficult decisions at the time when things aren't going well. Everyone can make money by when market is going up and you just buy things that are the hottest, and that's great.
Yeah.
But it's when things are going against you, and to be rational during that time and to make the right investment decisions more often than not, and accepting the fact that you're going to be wrong at least 40% of the time. And that's okay. And be right and just be comfortable with that. That is the most difficult. To me, that is the most difficult part about being an investment manager, is to have the conviction, but also have the mental flexibility to say, you know what? Things have clearly changed. Here's what I thought was going to be happening, but they're not happening now. Not because the shares are down 20%, but because there's these things that have changed that I was looking for that are no longer there, or moving in completely wrong direction. And now I'm trying to justify this investment that is down 20% for some other reason that wasn't there in the first place. And being honest with yourself and stepping back and say, you know what, that's probably not.
It takes a lot of courage, and you have to keep your ego in check. Actually, ideally, if you can leave the ego out of the conversation as much as you can, whatever process you need to have. Maybe don't even talk about the idea you bought so that you don't have to feel that your name is behind it and so on. It's fascinating how much courage it takes. And you pointed it out that we really make the biggest difference as a profession if you really want to take it seriously in times when it's really difficult to do it. Both hold on to things, both admit and sell, and buy things. March 2020 comes to mind. It was a very peculiar time, right? We were sent home. There were lockdowns. The market dropped by 30-some%. The economy, stopped, at least for a brief moment. And I was buying things. I saw stocks that were 5, 10, 20-year low, and I knew that it's a time of high uncertainty. I didn't know how long this will take, but somehow the optimist in me thought that those quality businesses with strong balance sheets have what I value the most. It's the ability to wait. The families I work with, most of all, above the capital itself, they have the ability to wait. And if your clients can wait and the businesses you own can wait, you have a massive advantage in moments like this, that you can buy some stakes in incredible businesses and you can just wait. But we're on the other side of the coin these days with the market closer to its high. And I'm not asking for any prediction, but I want to ask you about a certain phenomenon I've been paying more attention to it, and I know that you and your firm has been writing about it, which is the fact that fewer and fewer stocks are responsible for the rise of the benchmarks that some people pay attention to. And let's pick on S&P 500 for a minute, 500 stocks, and you have a statistic that you bring up, that the number of companies within the benchmark that outperform the benchmark. I don't know if many people think about it, but I think it's a great question to ask. So when you look at the benchmark, you would look at I don't know, players in a soccer game. Like, who are the ones that are above? Who are the ones that are below? But if you look at 500 of them and you tell me that only 25% are outperforming the benchmark itself, it gets my attention. Do you have some thoughts about it? What is going on?
Right. So this is looking historically, and we looked at this because this data is available on Bloomberg, I think, for the last 12 or 14 years, and I didn't have a chance to find data beyond that. But looking historically, usually the number of companies that will outperform within S&P 500, that will outperform S&P 500, will range between 45 and 55%.
Right.
And that kind of, logically, that kind of makes sense, because you would have some businesses are doing better, some businesses are doing worse, but you should have about half that does better and half does worse.
Yeah.
And in the last year and a half, that number has shrunk to, as you're pointing out, so in 2023, that number was only 25% of the businesses have outperformed. And this year, and I haven't done this, I don't know what the answer is when you take July into account, because there's been some funky things going on in the market in the last week.
Right.
But if you take just in the first half of the year, that number has come down to just 21%. And we're just 21% of the index, and we can talk about the Magnificent Seven, but those are the names that are driving the performance of the market today. And in that environment, I mean, you can look at it and say those are phenomenal companies, and we can own them and just forget about it. But we can also step back and think about, well, you have a situation in which a few companies are doing really, really well. And if we look 10 years down the road, can we comfortably believe that most of the economic value generated within the economy will continue to go just towards these few businesses? Or will new competitors emerge, as has happened pretty much every single time in the past,
right,
will emerge and will chip away from their competitive advantage here and there and everywhere? If you take a look at the list of the top 10 companies by market cap over the last, I think, 40 years, and you do it like in 1980, 1990, 2000, 2010, 2020, those companies change. Funny enough, there's one company that's stayed since the 90s. It's Microsoft. But everything else, every other 9 constituents have been changing. So by buying S&P 500 today, whereas I think it's a third of the index is in this top 10 companies, the top 7 companies, are you comfortable making the bet that those are going to be the companies that will continue to outperform for the next 10 years? Or you want to bet another 490 names in the index? Or maybe even companies that are outside of the index? Because quite often what happens is that, and then if you take a look, so the other way that you can think about it is that you can look at the performance of S&P 500 and compare it to the equal weighted version of S&P 500. So where within S&P, different companies have different weight, but there's a version of the index that says, you know what, let's say each company is 0.2%
right,
of the index. And if you take a look at the performance of those two, once in a while, the S&P 500 will run out and get ahead of the other one, but then the weighted catches up. And it has done so. So if you take a look at the last 20 or 25 years, it catches up pretty much every single time. And the difference in the performance that between those two that can be attributed just to the last 2 years, once we had that phenomenon emerge once again. And you can bet on the index and just buy that.
Mm-hmm.
Or I would argue self-servingly is that you can bet on an active manager to try to find you a list of companies that will hopefully do better than the benchmark.
Mm-hmm.
And that's what we're trying to do by focusing on the fundamentals. The one thing that we focus on within our both Eastern European funds and US funds is how much money companies generate
Mm-hmm.
and what are we paying for that today. So the statistics that we give, and I don't have the numbers from today, but they're going to be within that, is that for each $1 million invested into our fund, you get to get a collection of 30 businesses that will generate about $130,000 of operating cash flows. That will translate into about 70 to 80,000 of free cash flow. That is after the investing into the business. And that 70 to 80,000 of free cash flow is going to be returned to you within the form of dividends and buybacks more often than not. And we feel very comfortable owning that portfolio. So it's about 7 to 8% free cash flow yield comparing to the benchmark,
Mm-hmm.
where the free cash flow yield of the benchmark is, I think, around 3.5% today. So we get to have a portfolio of businesses that generate double a rate of the free cash flow, that grow the free cash flow at a higher pace than the benchmark. And we
Mm-hmm.
think that if we push it forward over the next 5 years, we should do better. Time will tell, but that's our bet. And that's what we feel comfortable with going back to, because that's where our conviction is coming from
Mm-hmm.
in terms of what we're investing in. Because the conviction comes from understanding the businesses, understanding what they do with the cash, where it comes from, and where it goes.
So we started with understanding the earnings per share philosophy behind investing and what it's all about, the beats and misses that people pay attention to. And now you're doing this great reveal of what's a benchmark, because people say, outperform, underperform, but what is a benchmark, right? It's a man-made, selected group of stocks that can create results that are peculiar at times. And you pointed out two things. One, such a small percent of stocks are actually outperforming the benchmark. That tells you something. And second thing is, historically, the equal weighted and the market cap weighted, they actually trade together, which makes sense. All the companies are doing well and all of them are trading together. And right now it's a different phenomenon. And last point that you brought up that I find fascinating, I call the kind of investing I'm trying to do is investing with an infinite time horizon. The families I work with, they have an open-ended time horizon. They want to compound this wealth over generations to come. But I do realize that I'm up against a fascinating challenge, that the assets we hold very likely have finite lives. It doesn't mean that they will all go out of business, but their glory years are, a decade or two or three. Microsoft had this phenomenal comeback. So did Apple, by the way. People forgot, but Apple had its one success, a massive, very difficult period, and then a recovery with Steve Jobs coming back and giving it a second chance to live. But most businesses have a couple of things happening that you point out. One is that they stay at the top for a limited period of time, and actually that time has shrunk over the years. Those companies would belong to the 100 or 500 biggest companies for decades. Now I believe it's under a decade, some of the studies show. And you have to be prepared. And then as an active manager, that's something I pay attention to, that the businesses that I'm happy to own today might not be the businesses that I want to own, 10 or 20 years from now. And we have to be open to that. Steve, I have one last question for you. And I'm always curious about the definition of success. Personal, professional, whichever way you want to take it, or both. How do you think about success?
So I knew you were going to ask, and I had to think about it a little bit. And I think, to me, the success, and this is very personal, but it's really loving what you do and being able to do what you love as a job. And think, because I have 3 kids and we kind of and they're growing up, and they get the benefit of seeing their parents, both my wife and I, work, and both of us truly love our jobs.
Mm-hmm.
And we tell them they don't understand how lucky we are that we found the jobs that we have, that we enjoy, because you have 8, 10, 12, 14 hours a day that you're doing this, which is a significant chunk of your life.
Mm-hmm.
And if you don't like it, your life is going to be pretty miserable.
True.
But if you do like it, the quality of life goes up dramatically.
Mm-hmm.
And if I didn't do this professionally, I didn't have to think about money, I would still be doing the same thing. And if you can say that, that to me is a definition of success, because you get to take ownership of your time, and you don't do what other people want you to do, but you do what you want to do. And if you can find that, and that is the goal, obviously you can't start from that quite often, because everybody would want to be everybody want to have a job that they truly enjoy. You have to figure out what you like, and you have to figure out what you're good at, and hopefully the two can come together and you get to do that professionally. But that is, to me, the goal that you can work towards. And then if you can achieve that, then you can credibly say that you're somewhat successful.
I love the sound of that. And we've both been very fortunate on that front, that we both found something that we love to do. I would add to it, I have this idea that if you have to pick a doctor, for example, I grew up with two doctors, physicians in the house, and some of the stories are very close to my heart. And I always thought that you have to pick a doctor that love what they do. They go to bed thinking about it. They go to conferences, events. They stay on top of all the new developments. They have to love it. It's not a job. It's a calling. And they can't be doing it just for the money. You need a knee surgery. You don't go to a doctor that just looks at it and feels like, oh, this is the money they can get for it. No, you have to have somebody that does it because they just have to do it. It's their calling. And the last thing, you have to have somebody that cares. You need a doctor that cares. You need a lawyer that cares. You need a money manager that cares. They know your name. They know who you are. And they actually have huge respect for the money that you entrust to them to manage. And if you can find all three, somebody that loves it, is not doing it just for the money, and actually cares about you, I think you're in a very, very fortunate spot. So if you find somebody like that in any area of your life, hold on to them for their dear life. Absolutely. And your dear life, because that's a blessing. Steve, this was incredible. I really appreciate it. And I love the perspective that you showed us of both the US market and Eastern Europe, and being happily in the UK, looking from the outside onto both markets. That gives you, I think, a healthy distance, so you're not immersed in the investor panic and emotion as things happen, because you can quietly walk around wherever you are in the UK. Is it London?
It is London, yeah. And it's a lot of time to think, and kind of, because every time, especially with Eastern Europe, because of the connections that we have there, and I travel there quite often, you go and you get completely overwhelmed with the information about what's happening here, the rumors there, and you can step back. And I mean, our investment horizon is 10 years. It really doesn't matter what happened today. But the fact that I'm not there, and I'm able to step back and say, you know what, really analyze, discuss with my colleagues, and get to what is hopefully will prove to be the right decision.
I think it might be your secret weapon, that you can create that kind of physical distance so you can have an intellectual distance, and you can actually hear your own thoughts and realize, this is what I think. That's not what I've been told. It's hard to replicate that in the middle of Manhattan. I learned that the hard way. But I think what you've created... I love
Manhattan, yeah.
I love New York, but there are moments when you can catch yourself wondering, is this my thought, or did I just pick it up at lunch from somebody else? I think having that kind of discipline, it's a lot harder. Steve, thank you so much for today. I really appreciate it. I learned a lot, and I had so much fun. So thank you.
Thank you so much. It was a pleasure.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.